Hello, hello. Hello, okay. All right. We are live. I believe so. Okay, cool. All right, so we're live. This is day 2 of studying for the CPA exam. I'm doing the FAR section, but the reason I'm live streaming this is because I have created my own tool that is basically the purpose, if you haven't been here before, is to create a CPA exam prep that you can actually afford. So that's kind of the motto, the mission statement. But anyway, this is day 2 of studying for the FAR exam using my own personal tool that I've created using Claude Design / Claude Code. It's to the point now, version 4. I made a video about that you can watch, where basically everything's done. I'm pretty much just focusing on marketing it. So like actually, letting people figure out about it and adding more questions as time goes on. So this is the second live stream. Let's jump into it. And I'll probably be multitasking as well because I am also trying to create more questions in Claude Code here because my data resets in 46 minutes and I want to utilize all the data that I can. So before I get started, I'm going to go ahead and start a prompt. So create me more questions that are similar to the actual skills that you need to. Cool. So now that we have that started, let's get into the studying. I'll make sure it doesn't make me verify anything here. I believe that's good. So that's creating more task-based simulations for the FAR section, and I'll create more sections as I study for this. But yeah, okay. So once again, like last time, and I've updated it, which is I'm pretty excited to use. But I now have a section where it's unanswered and answered because last time I did this with y'all, we didn't have this option. So now I'm obviously going to go through the unanswered since I won't be repeating the same questions as I did in yesterday's live stream. And just let me know in the chat if you have any questions. I'm going to go through these and talk through them. And obviously you can use the 7-day free trial for this if you want to follow along or do it yourself. Like I said, I'm trying to create the cheapest possible CPA exam prep study tool where you can actually pass just for it's $19 a month, or yearly plans even cheaper per month, or the lifetime plan. So let's get into this. We'll do unanswered. We'll keep it at all, and we'll keep it at all topics. All right. And like I said, I apologize, but I'll be checking this occasionally just to make sure that everything's working. So yeah. Building valued at $300,000 by paying $100,000 in cash. And Existing $200,000 mortgage. Okay, cool. And like I said, here's an explanation. I would explain it myself, but honestly, looking at this is better. That's why you should use the study tool I've created. But yeah, only the cash portion is an investing activity, and then assuming the mortgage is non-cash. Investing outflow. Supplemental non-cash investing and financing activity. Cool. And we're going to do just 50 of these and call it a day like we did yesterday, because on the actual FAR section, there's 50 multiple choice questions and then 7 task-based simulations, which we'll study a little bit later. Okay, fixed base price plus completion bonus that Ridgeline will earn in full. Finished early. Okay. So I would do, my guess would be 60,000 times 0.95 plus 400,000. So my guess would be B. Let's see. Okay, so it's for the full amount. Let's see why. But okay, the most likely amount method. Okay, so for the most likely amount method, it's used when there's only 2 possible outcomes. Okay, I was wondering why that would be used. So there's 2 possible outcomes, 95%, and then the 5%. And because of that, you just take the full amount rather than, see, I multiply it by the probability, but you just take the full amount. So yeah, value method. Okay, so if it were a large number of outcomes, then it would have been the answer I chose. But since it was just 2 outcomes, then you do the most likely method, which means it's the full amount. Cool, makes sense. Good to know. Okay, I should know this. Should be easy. And then I added these tags here, which I really like, so it kind of shows the difficulty level. Let's check on this. All right, give me a second. So I've been doing this, and then I'm going to queue this up. Cool. And let's see the storage. Cool. All right. Operating activity proceeds from issuing common stock. Believe that's financing. Cash paid to purchase equipment. Believe that's investing. Cash dividends paid to shareholders. Believe that's financing. Interest paid on borrowings. I think it's this. Cool. Interest paid is an operating activity because it enters into the determination of net income, a fixed rule with no permitted alternatives. Cool. And yep, those were financing and then investing. Cool. Awesome. And like I said, I'll be adding way more. This is, I only have 98 unanswered questions, but I'm going to be adding 100 plus questions a day. So, I'll get this to 1,000 plus in no time. And remember, there's a 7-day free trial, no credit card required. So, yeah, try it out if you want. Okay, 500,000. Okay, basic earnings per share. It should be easy. 500,000. I think you subtract out the preferred stock. Let's see. So 10,000 times 100 times 0.05. So I think it would be 500,000 minus that calculation, which is 50,000. It's 450,000. So I think that would be it. Cool. But another easy one, which is appropriate for that. Yeah, pretty self-explanatory. You subtract out the preferred stock or preferred stock dividends. And I like this accuracy bar because you have to get a 75% to pass, the exam. So you can kind of see where you're at every session. How an estimated credit loss should be measured and reported. Is an amount for credit loss representing the present. Not sure. Cool. Okay. Under CECL, credit losses on receivables are measured as the present value of expected cash shortfalls over the asset's life and recorded through an allowance account. Not right now, following the default is confirmed. Dang, I only get one that's not all easy. Let's see here. I think it's just coincidence, but we'll see. If not, I can just shuffle them. It's not too hard. 2% of the remaining collectible account that is collected to be in the current year. Modified accrual basis. Okay. I believe under the modified accrual basis, you do what you estimate at the beginning of the year. So 2 million, 2% of 2 million is 40,000. So I believe it would just be 40,000 subtracted from that. Okay, cool. Property tax revenue is recognized when measurable and available, collected in the period or within 60 days after year end. Finch corporations preparing financial statements. Okay, cool. It's good. It's a medium one here. Nice. The following items best illustrates the qualitative characteristic of comparability. This is pretty self-explanatory. It should probably be easy, to be honest. Might change that. Yeah, comparability. FIFO applied every period. Yeah, because you can't use a different accounting principle, or else that would be against comparability. It's pretty much common sense because that would be favorable representation. That's relevance, and then independent CPA audit would be verifiability. So just something you got to memorize. Uh, 400,000 employee stock options. Reg. Treasury stock method. How many incremental shares should Kingsley add to the denominator when computing diluted earnings per share? How many incremental shares should Kingsley add to the denominator? Okay. Add. Okay. Actually, not sure. I don't remember the treasury stock method. All right, let's see why. Assumed option proceeds, repurchase shares at the average market price. Only the net unrepurchased shares are added to diluted EPS. Let's see this. Result 40,000. Assume proceeds 800,000. Share average price. Okay. So you multiply it by the assumed proceeds, but then divide it by the average price. And so the incremental shares that were added would be the difference between the two. Okay, and it's dilutive because the average market price is greater than the exercise price. Cool. Stelling Corp, 100,000 shares of common stock outstanding. Oh, this is hard. It's diluted earnings per share. Okay. I'm also thinking about gamifying this app more. So let me know if y'all want that, as in like leaderboards and way more stats. But I also kind of want to keep it simple. So I'm kind of just listening to user feedback on that. But let me know what you'd rather have. I think gamifying it would be fun, but might be too much fluff and not enough substance. So I just kind of want to hear feedback on that part. Diluted earnings per share. And a lot of these I'm just going to guess so I can see the answer. I don't really, I'm not going to work it on paper because y'all can't see that. So I'll just, sometimes I'll just answer these. I think you would do the net income and then minus, let's see, net income minus 5,000 times 100 times 0.06 is 30,000. Each convertible into 4 shares of common stock. Here's I actually got 4 on the dot, so I must be doing something wrong. Yeah, I'm not sure. I'm going to have to just read it. Thought I was onto something, but I don't know. Okay. So, yeah. So for diluted EPS, use the if converted method. So it assumes that everything is converted that can be. So let's see how it actually does it. So cumulative preferred dividends. Yeah, I did that part. I also did that part. And I got to there. Oh, so I did it for basic EPS. So if converted, okay, yeah, you keep the 30,000. So you add back the preferred share dividends. And then the additional shares, 5,000 that can be converted is 4 is 20,000. And okay. So it ends up being 500 divided by 120. Yeah, makes sense. You add back the, oh yeah, I like this description here. Simple, straight to the point. Add back $30,000 of cumulative preferred dividends and then you also add to the denominator 20,000 of converted shares. So it was 5,000 shares times the 4 shares of common stock. And then you divide those and get the answer. Cool. Good to know. Okay. Corporation reported net income of $100,000 for the year and had a weighted average number of common shares outstanding of 25,000. Oh, wait. Okay. Yeah, that was easy. I want all questions to be like that. That is fantastic. It's literally just the net income divided by weighted average number of common shares outstanding, which is 4. Basic EPS, pretty simple. Perpetual system FIFO cost method. Okay, it's either A or D because they're using FIFO. So these are the oldest. I believe it's this. Okay. Perpetual FIFO, a physical inventory shortage is written off at the historical cost of the oldest units because FIFO assumes the oldest costs are consumed first. So why would it not be D? Let's see. Okay. Okay. So remaining on hand, but FIFO doesn't use the first ones remaining on hand. They actually use them. Remaining on hand would be the later ones because the first ones were used because we're using FIFO. So we're up 100 units at the FIFO costs of the units that would have been sold and adjust cost of goods sold because the first ones are the ones that are actually being used. Cool. No, whoops. Yeah, I meant bar. Glad I caught that. Pinecrest Corp has 100,000 shares at $2 par common stock. Dang, it's giving us a lot of EPS questions. Interesting. What's equity of that? Declared a 20% stock dividend when the president. Give the stock dividend. Okay. The shares of $2 par common stock. Yeah, 20% would be 20,000 shares. And $15 market price is 300,000. Stock dividend means you're paying it out, so I believe it'd be this. Ooh, okay. Stock dividend reclassifies amounts within stockholders' equity. Okay, it just reclassifies it, but it still stays in stockholders' equity. Dang, that tricked me. Okay, so it goes from common stock to additional paid-in capital, which are both part of retained earnings. Yeah, okay. And then nice journal entry here. Retained earnings, and then common stock and additional paid-in capital, which are part of retained earnings. Because no assets leave the company, total stockholders' equity stays the same. Cool. Okay, governmental accounting. A city's general fund issues a purchase order for supplies estimated to cost $50,000 and records an encumbrance. Actual number is 48. Budgetary encumbrance accounting. Yeah, I don't know what that is. We'll see. How should the city record the receipt of supplies? But, well, we can use common sense. Budgetary accounting, so they probably budget it at 50,000. So dang. Okay. So they do it as an encumbrance first and then record the expenditure later. And then when they do that, they reverse the encumbrance. Okay, good. Glad it's got some journal entries here. Encumbrances. Okay. That reverses and then that's paid. Cool. I like that. Journal entry helps clear it up. Okay, the estimate is fully reversed and only the actual liability is recognized as an expenditure. Cool. Only the actual liability is recognized as an expenditure. Awesome. All right. Lease for equipment with an 8-year remaining useful life. 6 years, present value. Lease payment is $180,000. Fair value of the equipment is $200,000. ASC 842, which the following classifications is correct. Okay, so I know that it's a financing lease if one of the 5 criteria is met. Otherwise, it would be an operating lease if none of the 5 criteria are met. So here, the fair value is 200,000 and the present value of the lease payment is 180. Therefore, that's 90% of that. And I believe that's one of the rules. So I think it's B. Okay, cool. Yeah. So these are the owns criterion. So basically, if any one of these is true, yeah, basically, if any one of these is true, then it's a financing lease. And also the lease term versus the remaining economic life. The lease term is 6 years, and it was an 8-year remaining useful life, so that was 75%. So that also would constitute it as a finance lease. Cool. Year 7-year useful life, fair value of 220,000. Company's incremental borrowing rate is 6%. Present value of lease payments is 229,000. Okay, same concept here. 7-year useful life. Let's see, fair value, present value. Okay, so it should be a financing again because the fair value is less than the present value this time, which means it's over 90%. Yeah. Once again, same thing, the owns criterion, which is, yeah, satisfied that one. But if it wasn't for that one, it would be an operating lease because none of the 5 were met. Face value, 5-year bonds, annual rate, market rate was that, premium for that. Effective interest method. I should know this, but it's a lot. Okay. Interest expense. Let's see here. Okay. I believe the interest expense portion has to do with the market rate. Okay, I did 108,000 times 6%, which is the market rate. So I believe that's the interest expense portion. So 6480. Nice. Let's go. And then you can see a nice journal entry here that kind of helps explain it. The amount of cash is 8,000, but the interest expense portion is only that we calculated, and then the premium would be the remainder. It's like the discrepancy between the face value stuff and the interest rate stuff. That's for current calendar year. Expects to collect that, and then that 150,000 within 60 days after year end. Modified accrual. So I believe it's going to be the 4.8 plus 1.5. So 49, 49.50, I believe, because it satisfies the 60-day rule. Nice, cool. Tax revenue, property tax under the modified accrual accounting. Property tax revenue is recognized only when measurable and available, whereas the normal accrual would be it's measured when earned. But for the modified accrual, it's recognized only when measured and available, and it's net of estimated uncollectibles. But don't confuse modified accrual accounting with just accrual accounting, because I think accrual accounting is when it's actually earned, which would change this answer, I believe. To maybe 4.8. I'm not sure, but yeah. Oh, hard question. Doesn't look bad though. The old machine originally cost $100,000 and has accumulated depreciation of $70,000. Old machine accumulated depreciation. Fair value is that. Okay, so that's a gain of $15,000. Its average pay is $2,000 in cash in addition to surrendering the old machine. Okay, I think it's just this. No. Okay, because I did 100 minus 70 is 30. Fair value is 45, so it's 15 gain. But then he pays 10,000 cash in addition to surrendering the old machine. So I thought it'd only be a 5 gain. Let's see. The new machine is 45 plus 10 is 55. 70, 55. That's 15. Huh. Cash paid adjusts the cost basis of the new asset, not the gain recognized on surrendering the old one. Interesting. Okay, the old machine. Okay. So I guess the $10,000 cash raises the new machine and old machine's value. Interesting. Okay. Well, there's your explanation, but it's confusing. All right. Sorry, let's see here. Inventory using FIFO. Yeah, let's see this real fast. Cool. Perfect timing. Okay, FIFO year end. One product class of 200 units. Historical cost of 50 per unit. Estimated selling price is 60. Okay, this should be pretty easy. All right, let's think about this. FIFO. 200 units, $50 per unit. So that's 10 grand. So just 10 grand. Might just be 10 grand. Okay, let's see why. Okay, the lower of cost or net realizable value. We knew we knew cost was 50, but net realizable value is 45. So you take the 45, not the 50. 45 times 200 is 9,000. So it's to lower the cost or net realizable value. I forgot. I thought it was just the cost, but that makes sense. Cool. Yeah. All right. Manufacturing company sells products under warranty. Covers effects for 2 years. $45 per unit. We sold 8,000 units this year. $200 each. What amount should the company accrue as a warranty liability at year end? I would probably think D. Okay. A warranty liability is accrued when the obligation is probable and the amount is reasonably estimable, and it was estimable. 3% of 8,000 units is 240 units times $45 cost a piece was 10,800. This is because the loss was probable and reasonably estimable. Cool. Which the following cash transaction should be classified as operating? Okay, this is an easy one. I better get this one right. Purchase of equipment is investing. Paid to retire long-term debt. Financing maybe, or investing. Cash received as dividends. That should be it. And then cash to repurchase the company's own common stock. Financing. Okay. Interesting. All right. Real fast before I continue. Yeah, that was pretty self-explanatory. I want to see. Okay, repurchase of common. Okay, retired long-term debt is financing. Okay, cool. Equity method income for year one. Okay. 20% interest for 500K. The book value is 1.6 mil. I feel like it's just. Yeah, I mean, I feel like it's just 120 times 0.25 is 30,000. You must have to do something with the warranty. Yeah, I didn't do anything with amortization. Dang. Yeah, I should have locked in more. So it's a 30,000, but then okay, less the patent excess amortization. Okay. So I forgot the amortization. If you subtract out the 100 divided by 8 is 12.5, then you get 17.5. That's the answer. See here, it left out the amortization of the patent. Receive customer deposits of $80K in advance for goods to be delivered over the next 8 months. Okay, how should Harding classify this amount on its balance sheet as the balance sheet date? In advance shouldn't be revenue. Yeah, it should be this. Cool. Because cash was received before a performance obligation was satisfied, so it creates a contract liability. Yeah, it creates a liability, not revenue. Once it's recognized as revenue, it would be a debit to contract liability and a credit to revenue. But right now, it's a liability. Yay, easy one. 84,000 minus 4,000 is 80,000 divided by 8 is 10,000 a year. Cool. I wish they were all that easy, man. Which of the lines are requirement when identifying performance obligations? I don't think it's C because it's when it's performed, not when cash is received. Don't know about D. Depends on the method, I think. I'm not sure. Yeah, I should guess B. A didn't sound right. Performance obligation is a distinct good or service one the customer can benefit from on its own or together with other resources readily available to the customer. So identifying distinct goods or services the customer can benefit from alone or with other resources. Okay. Core of step 2. Okay. Cool. According to US GAAP. Okay, so this is for not-for-profit stuff. I think it's D. Yeah, it's just kind of something you got to memorize. Unconditional pledge with no barriers recognizes revenue immediately because it's unconditional, and it's measured at the PV of future cash flows with the discount accrued each period. Cool. With a carrying value of $900,000, which includes goodwill of $200,000. During the annual impairment test, fair value. Okay, fair value is less than carrying value, which means I think impairment exists. But let's see. Carrying value. Okay. Yeah, I'm dumb. Let's see. So carrying value is greater than fair value, and then you basically just take the difference. Because if carrying value is greater than fair value, then impairment exists, and then you just take the difference, I believe. Yeah, goodwill impairment equals the excess of the reporting unit's carrying value over its fair value capped the goodwill balance. Okay, capped at the goodwill balance. So if it was over 200,000, then you would just take the 200,000 because that's the goodwill balance. Cool. That was easy. I don't know why I messed that one up. Okay, hard one. Let's see. Marine Corp sells its office building to a buyer for $700,000. Immediately leases it back under an operating lease. The lease payments have a present value of $210,000. What gain should Meridian recognize at the time of sale? I don't have a clue. Let's see. All right, let's see. Only the gain attributable to rights transferred to the buyer leaser is recognized. The portion tied to the retained leaseback right is deferred. All right, let's see. So that was the gain. Or the total gain. But then he leases part of it, 30% of it, back. Okay, and so he only has 70% of that gain left. And the remainder is deferred. And the gain is offset. And the gain offsets the right of use asset at lease commencement. Okay. Okay, so 30% of the lease needs to be deferred. And the other 70% is the using the calculation. Okay, additional paid in capital. We purchased 5,000, $18. Uh, 5 times 18 is 90. Okay, we're just focusing on the reissued shares. It's confusing because the common stock is 1. So would it not be 44,000 minus 2,000, which is 42,000? Let's see. Okay, reissuance proceeds. Cost of treasury shares reissued. 36. Okay. Cool. So it's the 2,000 shares times the discrepancy of the $4 or the $4 per share times 2,000 shares, $8,000 excess over cost. All right, I'm gonna get one right. Let's see. I think it's D. Nice. Okay. Conditional promise to give is not recognized as revenue until the barrier is substantially met. The matching requirement is explicit barrier, not merely condition. Subsequent. I wonder what it means by substantially met. I guess it would be like 75% or something to be considered substantially met. Or maybe it'd be more like 90%. But yeah, none of it's recognized because they haven't raised all the funds that it's contingent upon. Yeah. Since it's contingent upon raising that much, they haven't raised that much or substantially that much yet. Therefore, they can't recognize any revenue yet. I'll change this a little bit. Cool. Let's actually do. All right, 20 more questions. I believe it's net of that. No, I think it's A. Dang it, it was D. Okay. So you only you recognize it net, which I thought originally, but then I changed my mind. And then you recognize an asset for the expected cost of goods to be returned. Okay, estimated returns are excluded from revenue and recorded as a refund liability with a separate asset for the right to recover returned goods. And you record a $40,000 refund liability recognized an asset for the expected cost of goods to be returned. So it'd be like cash or accounts receivable for the whole 500, but the revenue would only be 460, and there would be a refund liability as 40,000. Those would be the two credits. All right. All right. Original gift of $1 million. At year end, the fair value of the endowment fund has declined to $940. How should this $60,000 deficiency be reported? Not sure. Okay. The entire underwater endowment, including the $60,000 deficiency, remains classified with donor restrictions. Cool. Okay. So revenue when recognized. Hmm. Should be the full software license. Okay. So it would be 400 divided by 400 plus 200, which is 600, times the 480. So I believe it's 320,000. Okay. Yeah. So you take the total as the denominator, the license allocation as the numerator, divide them, you get 2/3. Then you multiply it by the license revenue. Correctly applying the relative SSP allocation to spread the contract discount proportionally across both obligations. Okay. During a period considering rising inventory costs, a company using LIFO will generally report lower net income. Yeah, it's because they're being pulled last, and since your inventory is getting more expensive, that makes sense. So let's just find this answer. No. Yeah, pretty easy. Should be an easy one, not a medium one. All right, 16 more. Whew, we're getting through this. Okay, cost of 450K. Okay. 450. But the parent's measurement of non-controlling interest was 150, so you add that to the 450, so it's 600. And then the fair value of the subsidiary was 500, so it should be the current value, so like the present value minus the fair value, which is 100,000. Nice. Goodwill equals consideration transferred plus NCI at fair value minus fair value of all identifiable next net assets. Cool. This is just for the goodwill method. Also known as the entity method. Using the entity method, yeah. Cool. City collects property tax for the upcoming fiscal year under the modified accrual basis. When should the city recognize property tax revenue in general fund? Modified accrual, so I believe it's, yeah, should be that one. Accrual is different. It's accrual is when it's earned, but modified accrual is when it's measurable and available for use up to 60 days after year end. Cool. Okay, indirect method. What amount should Hartwell report its net cash flow of operating activities? So you do the you start with the net income and then reverse the opposite things to get the net cash provided by operating activities. So you do 184, add the depreciation, accounts receivable decrease, so you add it, inventory increase, so you subtract it, accounts payable increase, and it's a liability, so you add 11, sold equipment with a book value, it's the gain, you subtract the gain. And then after doing all those, it's 205, which is an answer choice. Yay, let's go. So net income is adjusted for non-cash items to get the net cash from operations. expense reporting requirements for not-for-profit organizations, nonprofit organizations. No clue. Yeah, I just guessed. Both functional and natural classification. State government general fund receives property tax revenues and allocates them to operating department. Okay, general fund. I think general fund uses A, but it's confusing. Governmental fund, I believe it's A. Okay. Governmental fund statements, including the general fund, use the current financial resources measurement focus and the modified accrual basis accounting. That's the governmental fund statements. Then government-wide statements, which is super similar but different. It sounds super similar, but it's different. Use the economic resources measurement focus and the accrual basis of accounting. So yeah. Modified accrual revenues are recognized when measurable and available. Expenditures are recognized when the fund liability is incurred. Expenditures are recognized when the fund liability is incurred. Okay, company recognizes $80K in warranty expense. Warranty costs were deducted only when actually paid. Oh, temporary difference stuff. Goodness. $200,000 in warranty payments were made during the year. Divided by 4. Maybe B. Warranty payments, then you multiply by the tax rate. Or it's either A or B, I believe. Okay, never mind. I have no clue. Okay, deferred tax asset arises when GAAP expense exceeds the tax deduction. The asset equals the resulting temporary difference times the enacted rate. Okay, warranty expense and warranty payments. Temporary difference. Okay, so you subtract that at 55,000 times 25%, so times the tax rate, and then that's the deferred tax asset. Okay, the actual taxes is the deferred tax asset part. Cool. All right, 10 more. $200,000 face value, 3-year bond. Okay. Okay, what's the carrying value immediately after the first interest payment? 3-year bond, stated annual interest rate of 5%. So 5% of 200 is $10,000, I believe. After the first interest payment, so I believe it'd just be 190. Huh. Okay, so the carrying value remains the same. I was mistaking that with, yeah, I was confusing the interest payment with the principal repayment. Because the interest expense never hits the carrying value of the bond. Okay, under ASC 18. I'm not sure. Economic exposure. All right. Special gasoline tax. Tax is not associated with the capital or debt repayment, but it's a special tax. So it's not that. It's not that because the question says it. It's not general fund because it's a special tax. So it would be special revenue fund. Yep. Like obviously, if it said it was a capital or debt, then it would be whichever one it says. But since it wasn't those, but it's still special, then it just goes in special revenue fund. During the year, customers were billed 2.5 mil for services provided. Okay, under accrual accounting, customers were billed 2.5 for services provided. Of that, 9% was collected, but under the accrual method, it is when it's performed or like services are provided. So it should be the full thing. Cool. Revenue is recognized when services are provided, not when cash is received. Yeah. So if it was just if it there would be cash basis if it was cash is received and it'd be C, but since it's accrual, then it's the full amount since you provided all the services. Cool. Pretty straightforward. You just got to know the difference between an accrual and cash. Accrual is when services are actually performed. Okay, what impairment at the end of year 3? So residual value 40, useful life of 10 years. So it's 80,000 a year in depreciation, which at the end of the year 3, 80 times 3 is 240. Um, okay. So 80 times 30, 240, so it's 600 carrying value. Okay, so I think I learned this. If undiscounted future cash flows are lower than the carrying value is 600,000 because it's the 240 depreciation subtracted from the 840, which is 600. Since 560 is less than 600, then impairment exists. But to actually see the value of the impairment loss, you do the 600 minus the fair value of 490, which is 110,000. So it should be D. Nice. And then here's the basically what I kind of explained. But so you subtract the depreciation, the carrying amount is greater than the undiscounted future cash flows, which means it's impaired. But to actually calculate it, you subtract the fair value from the carrying value and get 110,000. All right, 30%. So there's the equity method, 30% for 600,000. So reported net income of 200,000. All right, this is pretty easy. So purchased 30% of Soren for 600K. And it says it's significantly influenced. So then you just take the proportions of it. So 200 and then minus 50 is 150. Ooh, what about the unrealized gain? Um, I'm not sure if you be 150,000 times 0.3. And you add that, so 645. But I'm not sure if you include the $20,000 unrealized gain, since unrealized. I feel like that doesn't need to be included. So I think I'm going to try 200 minus 20 is 180 plus 50. Sorry, minus 50 is 130. 130 times 0.3 is 39. So I'm going to go with C, but it could be B. Dang. Okay. So you do include the unrealized gain, I guess. OCI items flow to investors' own OCI, not through the investment's income pickup. The $20,000 OCI gain is excluded from the income pickup. Patel's 30% share of that item. $6,000. Just Patel's own OCI, so it really does not affect the investment carrying value calculation here. Dividends. Gain is included from the income pickup. Patel's 30% share of that item. Adjust Patel's own OCI. So basically, you include like you don't subtract the unrealized gain out, since it's already included in net income. You leave it there. So 150 times 30%, which was, what was it, 145.3 times 150. 45, and then you add it to the 600,000 to get 645. Cool, makes sense. All right, four more. Okay, like Vucor acquired equipment valued at 400 grand by issuing long-term notes payable directly to the seller. No cash change hands. If no cash change hands, should be disclosed in a supplemental schedule. Nice. So yeah, it must appear in non-cash investing and financing activities. Supplemental schedule. Real cost in 20 years is $500K. Credit risk-free rate is 8%. Oh, goodness. I don't remember this. I'm going to guess and read the explanation. Let's see. Under ASC, okay. An ARO, asset retirement obligation, is recognized at fair value on the date the legal obligation is incurred, and that same amount is capitalized the related assets carrying amount. So it's the costs plus the present value of that times that. So it's that. No, never mind. Never mind. Okay. It's the estimated removal cost times the present value factor, which is around 100,000, and then you add that to the tank purchase price. The total initial carrying amount of the tank. What's the total initial carrying amount of the tank? So you add the asset retirement obligation to the initial carrying amount. During the year, several individuals donated their time to a not-for-profit organization. Should be the organization should the organization recognizes both revenue and expense. I think it's for specialized things, so I believe it'd be C. Okay, cool. Yeah. Create or enhance a non-financial asset or involve specialized skills provided by individuals possessing those skills and would typically be purchased if not donated. So yeah, attorney. Definitely a specialized skill. Under ASC 805, how should an acquirer account for direct costs incurred to effect a business combination, such as legal, accounting, advisory fees? Direct costs incurred to effect a business combination. So it's not B. I'm gonna go expense. Let's see. Because the direct cost part sounds like it would be capitalized, but let's read it. My gut told me expense, but because the legal, accounting, and advisory fees are usually expense, but direct costs kind of confuse me. Okay, requires acquisition related costs, legal, accounting, advisory, evaluation to be expenses incurred. They're not part of the consideration transferred. Not part of consideration transferred. They do not create an asset. Okay, expense. Internal acquisition department costs are also expense. Cost of issue debtor. The costs do not represent assets of the combined entity and delivery eliminated the capitalization approach allowed under prior purchase method guidance. Because they do not represent assets of the combined entity. Cool. So legal, accounting, and advisory fees are expenses incurred. Let's do a bonus because this one looks easy, and then we'll call it. Personal cards do not expire and have no breakage expected. When should the retailer recognize revenue from the sale of the gift card? It's when the services are provided. So it shouldn't be A. Should be B. Because when the gift card is sold to the customer or when it's first activated, it would be deferred revenue, but it's actually recognized as revenue when they actually cost you something, because that's when your services were provided. So it should be B. Okay, cool. Revenue is recognized only when the performance obligation is satisfied. For gift cards, that moment is redemption when merchandise is transferred to the customer. All right, and there you have it, folks. It's that study session number 2. Tune in next time for FAR Day 3. Like I said, use the tool. There's a free trial for 7 days, no credit card required. Let me know your thoughts. Let me know some user feedback. You can email me. My email is posted everywhere on YouTube and on this website. Let me know if y'all have any questions, and I will see y'all next time. Peace.